Welcome to Fintech Fridays,
Oh yeah!
a weekly podcast brought to you by the National Crowdfunding and Fintech Association of Canada and partners, covering all things fintech, blockchain, P2P, AI, and alternative finance.
Hello everyone, it's Craig Asano, the founder and CEO of NCFA Canada, welcoming you to Season 4, Episode 66 of Fintech Fridays. It's a weekly podcast brought to you by NCFA and our partners, featuring conversations with leading voices across fintech, funding, and financial innovation. We walk and talk to all the founders who are doing incredible things. We talk to them about their journeys, new product innovations, emerging trends in their market, and what's happening in the market right now from their perspective. So today we're super excited to have another fantastic guest with us, and I'd like to introduce you to David Jens. He's the founder and CEO of Merchant Growth, a Canadian digital financing platform for small businesses. So after graduating from UBC with a Bachelor of Commerce in Finance, David started his career as an analyst at a private equity firm called Kai Capital Partners. And in 2009, at the young age of 22 years old, we're going to get into this a little bit, just after the aftermath of the global financial crisis, he founded Merchant Growth to help address the gap in access to capital for Canadian small businesses. So during the last 15 years, I guess, Merchant Growth has helped more than 15,000 businesses access over $1 billion in financing through technology-enabled lending solutions. David also leads Merchant Opportunities Fund and has been recognized as a Business in Vancouver Top 40 Under 40 and BC Business Top 30 Under 30 and an EY Entrepreneur of the Year finalist. So David, thanks so much for joining us today to share your knowledge and expertise.
It's my pleasure to be here. Thanks for having me.
That is a mouthful. You have a lot of accolades there. I've always
you didn't have to read. You didn't have to read all those. You don't have to read all those.
Remember the 30 under 30? You've got a hell of a story, and we're going to get into her, right now. But just to kick things off, I think let's get in with the first question. Despite the advancements of technology and more financing for small business options than ever before, small businesses, it seems, it's always never enough capital. There's always a struggle there to get enough capital to continue to grow. But from your perspective, why is that gap? Why is it so challenging? And has it changed? Or, how from where you sit in the last 15 years, has it changed?
Yeah, it's changed. I mean, we have obviously made a bigger dent into the problem. There's also competitors that we have in a whole industry now that, really didn't exist when I started this. So a dent has been made, but that doesn't mean the problem's solved, right? It's a big problem. It affects hundreds of thousands of businesses in Canada. And the problem is just that they don't have the kind of access to credit or capital in general that a larger company does. A larger company has the resources to spend time sourcing capital in its various forms with finance teams. And also on the other side of the table, banks that are providing credit and institutions, et cetera, have the, kind of the scale in those transactions to staff them up, be creative, have professionals look them over and figure out custom structured solutions to provide that larger business with that capital. With a small business, none of that exists in that way. And so it's cookie cutter solutions that traditional financial institutions look mostly at assets and whether or not they can lend against those. And if you're an asset light, cash flowing small business, you're not given much credit from those traditional institutions. And if you think about most small businesses are asset light but have cash flow. They serve customers in local communities. They might have a little bit of inventory, but at the end of the day, they typically don't have a lot of hard assets. Any individual small business, by definition, they're small. But if you add them all up, they're about half the GDP. They're 2/3 of the country's employment. So it's a massive space when you really look at it as a whole. And so if we can make our dent in it, we think that is something worth doing and can really drive successful outcomes for more small businesses. We want to see a world where there's lots of successful small businesses. We're not all just transacting with these large behemoths. We think that's just kind of a more interesting world to be a part of, and so we're here to support it, level the playing field, and build a business ourselves out of it as well.
Music to my ears. I mean, you're fighting the David and Goliath battle sometimes, but it's the one that many of us choose to fight. Small business are innovators, and we sit at the heart of where that innovation is happening from the financial services side. So, hats off to you and to making it work, to the successes that you've had. So, let's talk a little bit for those who don't know about merchant growth, maybe introduce merchant growth a little bit and, that backstory, that founder story, how did you get into it? You were working at private equity. We had that global financial crisis, but at the ripe age of 22, you decided this, I'm going to have a go at this. So illuminate us on that founder journey a little bit.
Yeah, I was always driven to do my own business. I come from a family of entrepreneurs. My dad, brother, and uncle all had their own companies. I was a little bit entrepreneurial in high school. The thing that I sort of ran in an entrepreneurial way, wasn't very profitable, was my rock band. I had a band. I played the bass and I sang, but we were booking shows, getting shirts printed. We had a van. We were going around and making a go of it. And that was. Like I said, not a profitable venture, but nonetheless, it was getting a team aligned and making something happen. So I knew it was a matter of time. Eventually, I wanted to sort of start my own thing and work hard and hopefully see the upside of having equity in something that I build. I thought that I was going to last longer in that private equity world, but it became kind of clear to me that it wasn't scratching the itch for me. I really wanted to start my own thing sooner than later, and I got advice from my older brother, who, like I said, was an entrepreneur. He said, kind of, the sooner you get going, the better. Time is on your side. Things take time to build, and there's always an excuse, why you might want to not do it. Just ignore that and get going. So that is what I did. And I looked at this growing market in the US for non-bank small business credit and looked at Canada and recognized the huge difference between the US and Canada. There were already a few large players in non-bank small business finance in the US. That did not exist yet in Canada. And so I did a little more research. I talked to some small businesses, saw if, how do you finance your growth? Where do you get credit? And basically it was clear that they had no awareness of the space. There were a few players already in non-bank small business finance at the time in Canada, but they were tiny and no one had heard of them yet. So I felt like I was onto something and that Canada would play catch up to the US. You also had that backdrop of the great financial crisis and this multi-decade secular trend of less small business credit being provided by the banks, that only accelerating post great financial crisis. So, away I went with a business plan and started funding those first few credits, kind of word of mouth, found some small businesses with credit needs. But it was definitely very small, kind of humble beginnings. My initial goal was just to get the business to the scale where it could pay me a salary so I could, pay my cost of living, and do so being my own boss. Like that was goal number one. And then you kind of built it from there. One thing I liked about this business plan was it wasn't all or nothing. It's not like either, you succeed and it's something huge or it's a zero. It was more like, I just need to do a good job, be responsible, do a good job of underwriting, serve investors well, find more and more clients over time. And, I could kind of incrementally build that business over time. And so that resonated well in terms of my own kind of risk appetite, because I really wanted to, find something that would work and hopefully grow over time.
It's awesome. I in particular, I like the band part. Do you ever find yourself thinking back to those days and what happened to the band? Have you reconnected with the band?
So I still play music, and I continued
Okay.
playing in bands, even when I had the business. In 2013, for example, I was 3 years into this business, and I was touring with a couple different bands that year. So
Touring.
I,
Wow.
yeah. So I took it pretty seriously. This is obviously not the topic of the podcast, but one of them had a rock radio #1 in Canada, and so we opened for Guns N' Roses and Alice in Chains and a whole bunch of rock bands. So I got to like bucket list. I was able to play on some big stages for a bit, which was just so fun. But terrible way to make money. I mean, horrible. Especially those bigger shows where we were opening for bigger acts. Those were also the worst paying shows we ever had because you're kind of being paid in exposure instead of cash. So in any case, it was a lot of fun, but also not profitable. I continue to play music. I still do. Obviously, it's just for fun these days. But yeah, there is a lot of parallels for sure. It is a team sport, playing in a band, and the same way that team sports, help teach leadership and confidence, and also how to kind of collaborate and have a team dynamic. Bands certainly have all of those same elements, and I've got business partners in what I do today too. So equity partners, people who are like in it and on the roller coaster ride with me day to day, the same way as back when we had the band. So you kind of, if you want to do anything big, most of the time it does take a team to do it, right?
Well, I mean, you've got an appetite for some risk. Not everybody's willing to get in front of the crowd to open up for Alice in Chains and rip on a guitar. I was in
I was
drums.
on the drums for that one. Yeah,
Yeah, I'm talking grade 5 until I got kicked out of the band. But those early, well, see, it's interesting. Like to have that get up and go. Though there are some founder insights there. I think, as you were talking about team and collaboration and leadership, but really the problem, getting back to merchant growth that you were tackling is the one minus of more the traditional lending routes, the capital raising routes through the banks and the options. So building outside of traditional banking, in those early days, like how did you make it work? How did you build the trust? You were saying you found the business model that didn't have, excessive risk. It was something, as long as you worked hard, it was sort of contained. But there must be some challenging stories you remember and some lessons there that maybe you'd like to share.
Yeah, I think one thing that made the business model possible is that people were starting to get comfortable with financial services being done digitally, applying on a website, talking to someone on the phone, not necessarily meeting them in person. The idea of going into the bank branch was starting to slowly fade away. Obviously, we still live in a world with bank branches, but there's a ton of stuff now you do digitally. So that trend was helpful, but I was young when I started and didn't have a track record. And to your point, why would people take me seriously? And the truth is, it was hard. And a lot of, it took convincing. So, I think the one advantage was we were taking applications online and doing things over the phone. So people maybe didn't necessarily know how young I was. But I also had to, get the trust of investors who actually funded these financings, because I didn't have my own money at the time. So that part was as hard, if not harder, than finding interested borrowers. And so that was really, leaning on friends and family. It was small checks. Like I said, the initial goal was just to get it to pay my salary. So I wasn't trying to shoot for some crazy number. But I was willing to spend hours with someone who might potentially invest $5,000 into the fund right back then, and so I was just piecing it together bit by bit that way, and I feel a huge debt of gratitude today to those early investors, because they were investing really in me, the idea that I would continue to work hard and figure it out even if I made mistakes. That's what they were investing in, because there was no track record or platform or repeatable kind of process at the time. So, Today, obviously, investors are investing in, portfolio financings that's at scale, a statistical underwriting model that's been developed over a decade. We've got the largest data set on, credit performance for these types of small businesses in the country. And so it's, what you're investing in today is very different than what those early investors were having to trust to move their capital over my way back then.
There's a lot of excellent lessons in there, having just heard that approach, but the gratitude really stands out to never forget who helped you in those early days, and I can really respect that, and the friends and families. Everybody needs some help, and so that's on both sides of that, I think. But that's excellent because if you have the largest data set of the credit decisioning and maybe more for small businesses for the last 16 years in Canada here, you would be at the heart of, like, our Canadian small businesses. They're borrowing more. Are there more of these small businesses? Are we growing in the right direction? Based on that data set, I don't know if you've analyzing it in that context recently, but I'm just curious to know.
Yeah, I mean, we're closest to any data that pertains to our own applicants and customers. Obviously, we do track industry-wide stuff as well to understand how the market is developing, what our share of that is at, and where it could go as we kind of continue to plan for the business. But it hasn't been a fast-growing economy. In the last couple of years, we've seen slowing growth, but still positive real growth rates. I will say that our average applicant is growing a fair bit quicker than the Canadian economy as a whole. So we're seeing kind of high single-digit, even 10% kind of real growth rates at our underlying applicants, because it just goes to show that this business model self-selects for a higher growth borrower. The reason they're coming to Emergent Growth is because their businesses are growing and they're looking for credit to help them continue to grow. Most businesses have positive working capital, which means that as they grow, they need more capital. And so we are here to provide that.
So when it comes to merchant growth, you talked a bit, well, clearly, it's a digital model, and you've been at it for many years, but what about the products? Like, what exact financing solutions is there a huge range? Can maybe break that down a little bit for our listeners?
Sure. Our products today are term financing, which is, a lump sum up front, and then we're getting a payment, a payment daily or weekly that in most cases is based on the revenues of the overall business. So there's an ability to kind of reconcile and reset that payment level depending on how the revenues of the business are trending. That's called revenue-based financing. So effectively, it's like a royalty. We're buying a portion of your future revenues. We also do term loans, so that's just a straight loan agreement. With an interest rate and a typical kind of term loan setup. Also, in that case, it's an amortizing product, so we're always getting principal back with each payment. And last but not least is line of credit. So we also do have a revolving product. How that's evolved over the years. We started out just doing the revenue-based financing, and we were initially doing it based on credit card sales only, credit and debit card sales. That product is called a merchant cash advance. We started in that space. Then we went to overall revenue-based financing and term loans. But really the biggest innovation, I would say, is perhaps less visible to the customer, but it's in that automated adjudication. It's in the statistical scoring model. It's in the risk-based pricing. And what that has allowed us to do is accurately price risk across a spectrum. And so we're able to, win that very price-sensitive, super high credit quality, larger business and provide product that's appealing to that customer, but also say yes to the risky customer who is, much more likely to be declined no matter where they look. And we do that by understanding the underlying risk in each applicant. You can only do that if you just do a ton of financings and you're able to study the history of that and then use machine learning techniques to build sophisticated models to figure out how to predict those outcomes going forward. And I think that's been key to our success. our competitors were a little bit more like one size fits all. Here's roughly the rate, and it just applies to whoever comes in their door. And again, that's just not precise enough. And I think we've been able to really refine that, in a way that's allowed us to scale, more elegantly, I'd say, than other companies in the space.
Yeah, you often hear there's a lot of thin files or no files, but let's say it's an immigrant entrepreneur, a new immigrant to Canada, but they've got a ton of experience, and back where they came from, they get here, and they don't really exist on paper. Or would that be a good example? They come to you, and what would the journey, like, what would the customer journey be like? You've got advanced underwriting that adjudicates the risk and loans, but is it just a website? They come in and fill out some information. Walk us through the customer journey a little bit.
Yeah, that customer is potentially going to look slightly riskier to our algorithm, kind of all else equal, but not necessarily, right? Because the personal credit file of that individual is just one of many inputs into our own scoring model. We call it the merchant score. That's where we've used, machine learning to really get a lot of predictive insights from a variety of different data sources. So to talk about the customer journey and what those data sources are, one, it's the application that customer fills out on merchantgrowth.com or through a partner of ours. That's going to tell us things like years in business, industry, location, et cetera. The next is the personal credit file. We do still look at that, and there are predictive elements within that. But the next and most important is the bank transaction data. And so we get at least 6 months of bank transaction data from the operating account for that small business, and we run an algorithm that helps us figure out what the revenue of that business is. Remember, not every deposit into an account is a revenue. It could just be, the business owner putting money in, or drawing on a loan or something else. So really detecting what the real revenues are, what the expenses are, whether they're variable or fixed, and then being able to run analysis on that, and then various other things that you can basically kind of cluster data between the bank data and applicant data and other things to sort of get a picture on a certain dimension, which that might sound really complicated, but that's kind of the way machine learning works. Is you try putting different data together and see if it's predictive, and the algorithm learns over time. And then you also always do need to be able to explain it. Why is a high value good or bad, or what the case may be, before you include it in the model. But there is a lot going on there, and it's too much to even be able to kind of talk about in a very short podcast. But also on top of those three, there's a fourth data source, which is kind of a catch-all for all the other data we're able to pull, which includes the business's online presence. So do they have a website? Do they have online reviews? And how good are those reviews? How recent are they? How many are there? How is that relative to the size of that business? Does that sort of jive? All that kind of stuff. So that's important in certain industries, less important in others, and our score understands that, all of that. In other words, if you're thin file on your personal credit, but you got a strong business, like, we're going to notice that, and you're still going to get approved by us. And I think that's kind of one of the cool things about our business model, is we're trying to solve for, is this business, trending well? Is it sustainable? Does it have the cash flow to service credit? And on that basis, we make credit available.
And so that would be sort of a snapshot of more like a good customer, the ideal customer. They've got enough data. They're willing to share it. They need access to this capital, and they go through the adjudication engine. How long does it take for that the merchant score to pop out? Is that something that the customer that goes to the website, sets up an account, and they don't even call in, they go right to the website? How long, if they supply that information, is it something that happens real time? Is it instant, or is it like?
Yeah, so what I just described is filling out the application, connecting that bank transaction data. That can all be done as part of a 5-minute application, and then our score automatically runs. So there's no other human involvement required there. So within literally 1 minute of completing that 5-minute application, we have a yes or no, and here's what the offer could look like. Here are the terms available, etc. And at that point, one of our a representative reaches out to the business, explains the different options, acts as an advisor, kind of figuring out what would fit their need best. And then once the business owner chooses what type of financing structure they're moving ahead with, then contracts go out for electronic signature, and a few other documents may be requested. If it's a smaller credit request, then frankly, they just need to verify their identity, and away we go. If it's a larger credit request, we could ask for things like tax docs and financials, but it depends on the industry and the size of that credit request. But if you're if you're a small business owner and you're highly engaged with the process and you're looking to get it done fast, then we regularly, fund businesses that applied in the morning by the time the afternoon funding goes out.
And what are the size of those numbers on average, like the small ones versus the large credit requests? Is it that might take a little bit more due diligence? Where does that?
Yeah. So our funding amounts range from 10,000 to $1 million. We do a lot of small financing, so our average financing amount's about 50,000. Those kind of like more tax docs, financials, those kind of asks tend to kick in around between 150 to 300,000, depending on the industry.
Right, and so we have a picture of sort of the process and who might be suitable for it, who's not suitable really for that. That you might think it's not, it's not a good fit. We usually talk about, I think it's a good question that we usually bring up on this podcast. It's like the ideal customer. And it's also, hey, who's not the ideal customer? So people can understand that.
Yeah, one is just if it's day one funding, right? If it's a startup that's not in revenue yet.
Yeah.
I wish we could help those businesses. I truly do. But without any history of cash flows, there's just nothing to bank on for us using our approach. And so that is one area we can't go into. The other one is just lumpy cash flow profiles. So if you're project based, you only get paid once every few months when you complete a big job. That's too lumpy of a cash flow profile. Again, we're banking on the fact that you have some consistency in your revenues and your cash flows to be able to service the credit we provide. So things like resource extraction, that's obviously too lumpy of a business, and not to mention commodity exposed, but oftentimes it's exploration and pre-revenue too. So, we tend to fit best for those kind of consumer-facing small businesses, restaurant, retail, health and wellness, auto repair, et cetera, trades, maintenance trades. We do some B2B like wholesale, distribution, and manufacturing, but it's a smaller part of the portfolio. Again, just as long as the cash flow profiles are consistent, then that means that, more likely than not, that we are able to approve you if you also kind of meet just the minimum size and time and business requirements.
Perfect. No, that's a good answer. Let's talk a little bit about, since you've done, over 10,000 financing, so it's a big number to me in this manner with this approach and all those learnings and this massive experience. What you must have seen a lot of sort of truths or misconceptions that maybe some small businesses have. So it's a good opportunity to really dispel any myths that some small businesses might have that you've sort of seen as recurring patterns. You're like, here it is again. Is there anything that you see in the data or in your experience that sort of pops up and you say, hey, I wish, that we could advise them and tell them this is something that, you need to learn, make the process easier for everybody?
Yeah, it's going to sound like I'm kind of selling against myself with this comment, but credit is a tool. It's a powerful tool. It's an important tool. It's allowed, frankly, like humans to just progress in meaningful ways by taking capital from savers and putting that capital to productive use in other parts of the economy. We've definitely, advanced as a species as a result of credit to be can't really overstate that. But it's an excellent tool, but it can be abused just like any tool, and it's not the right tool in all circumstances. This doesn't apply to too many of these small businesses that we work with, but some of them will take whatever's available to them. And we're thoughtful about our offers. We always want to make sure they're sized appropriately and affordable. But not everyone in the space is as organized and diligent about that. And so, there are higher risk financing businesses that finance, frankly, the businesses that, we wouldn't finance, or perhaps we have financed, but we've maxed out on what we would do. And so, but these higher risk folks are still willing to lend them even more. And so you sometimes see small businesses carry multiple loans at the same time from, the non-bank small business finance space. And, that's tough on cash flow. It's tough to kind of, really make that work long term. It's not necessarily sustainable. You end up kind of on a treadmill with too much credit in your business. And so that is one thing that I kind of, the misconception, I guess, in that case is just like, oh, I qualify for this credit. I should grab it. I can use it, and it's going to help me. It's only going to help you if the return profile on the investment on that you're able to make in your business as a result of getting that credit, if the return on that is greater than the cost on your credit. And even if it is greater than the cost on your credit, you got to look at the time horizon on that. If it's not going to produce cash quickly enough, it's not really going to be positive for you cash flow wise in the short run, and it could potentially get you in a tough spot operationally if you're just really starved on liquidity. So that's one thing, is just to be careful about having multiple financings at once, and just making sure you have the right amount of credit that you feel comfortable with, that allows you to take the risk that makes sense, but not excessive risk.
There's a lot there. That's, I think a lot of small businesses get into that scenario. They've got their line of credit. That's more personal, I guess, or maybe the business line of credit. And then they get into those credit cards. How many times have we heard the stories, and, the single founder is using their credit card to launch a business, and maybe they're telling it in retrospect or in hindsight after they've had a great success, but risky days for sure. So I think that's certainly good advice. Moving, sort of zooming out a little bit about the landscape, small business lending landscape. What have you seen that's been sort of developments that in the 15, 17 years you've been at it? Because, through my research for the podcast, like one little breadcrumb trail is that Competition Bureau study. They're looking at, is there enough competition in SME financing? And so, what trends, or what are your thoughts on the amount of competition, and is it efficient market where there's the right size types of businesses coming to apply and getting funded? And to your point earlier, it's the fact that credit exists has allowed the humanity of small businesses to do things they couldn't do without it. So it's an incredibly useful tool, but from that competition angle, as well as some trends, what's happening in the SME lending landscape?
Yeah, I think that study is looking at all of the financing options for a small business. So it's looking at it in the context of the banks, the equipment leasing businesses, and government programs, everything and everything, anything and everything. I think in terms of getting more credit flowing and encouraging more competition. I'm sure you've talked on your podcast about open banking over time, so I won't beat a dead horse, I guess. But that would make it a lot easier for businesses like Emergent Growth to serve those small businesses in a consistent, cost-effective way and over time, as opposed to the connections we've had to rely on in the past that were less reliable than they would be under a proper open banking framework. So that is, it's been announced that's coming. So we're excited about that. I think that again, the space has come a long way in terms of the number of players and how much of the market we've been able to assist, but there's still a lot of work left to do.
Absolutely. Just curious. So you're based in Vancouver. You're national. You can service any small business nationally.
Yeah, absolutely. Yeah. That's always really been the case. I mean, there was a time when we didn't have French contracts, so we couldn't do Quebec, but that was a long time ago. So, yeah, for all intents and purposes, we're all over the country.
And do you find that I guess it's just a function where most of the small businesses I know in Toronto, GTA or Ontario, there's a lot of activity. Montreal's pretty hot. Vancouver has always been a hotbed of startups, but they might not fit that exact profile based on what you're talking about. But where's the distribution? Is it heavy Ontario? Where is it?
We are overweight slightly relative to the population in Western Canada, given our kind of roots and time zone and stuff. But and we're probably a little underweight Quebec just because we have not as many French speakers on staff, but we do have them across all the different functions in the business. But apart from that, it really is kind of wherever the Canadian population is. Ontario is our biggest market, and we look forward to actually doing more in Quebec in the near future as we plan to staff that up a little more. But yeah, that's kind of the makeup today.
Do you find, after being in the business so long and building, I'm not sure how large your team is, but as you scale, or do you still get excited about funding a particular business, story, and the customers come back and say, David, I got to come back and thank you. This has been the best thing that's ever happened to our business. And is that kind of partly what's motivating you? Is it the efficiency?
Yeah, I love it. I mean, that feedback loop for me these days is looking at our online reviews. Okay. So I see it there. I myself am rarely on the phone with customers anymore. But sometimes I am. We had this big sales push during the repayment of the government program known as CEBA, Canada Emergency Business Account, which was a COVID relief program, part of which was repayable all at the same time and in January 2024. And that was a huge push. We were just financing companies to take advantage of the government discounts that were offered if you pay out a lump sum in that January 2024 timeframe. So we had all of us, including me, like with headsets, talking to customers at that time, getting that done, which was actually a lot of fun. But these days it's mostly looking at those reviews online. We also have been using AI to study the conversations that we're having. It's pretty interesting, right? You could have AI look at the transcript from 10,000 calls and help you understand your customers and their personas, and that'll in turn help us serve them better. And their so that's been fun and exciting. But yeah, no, absolutely. Like, I love what we do because we're helping these small businesses. We're leveling that playing field, like I talked about earlier, between them and larger businesses. So big part of why we get up in the morning for sure.
So you touched upon the AI underwriting. You talked about other maybe creative uses for AI, just being able to help maybe some of the customer journey, or be interesting to match it against your merchant growth score to see if that could be even improved using AI, or maybe that's giving too much secret sauce away to AI as it eats everyone's lunch. But I want to focus on that AI piece and sort of the modern underwriting. You've obviously seen tremendous changes from starting 17 years ago was manual. I caught earlier you were saying some of it, you were still on the phone, but they were on the website. The customer didn't really know is you doing the phone call thing on the back. But maybe just add a little color to the use of AI. And I'm curious about the human oversight aspect. Where is the line drawn? Because everybody's getting jazzed up about AI agents, and this is the whole autonomous, and humans won't be involved. And then there's a whole other camp. And so where do you sit on that human oversight versus the AI engine that you've built, and you must have some vision or interest in maybe taking it further, integrating it further. So what are your thoughts on sort of the modern, how AI's modernized it, and people's involvement in the future here?
Yeah, I mean, I don't think it's completely black or white. There's no doubt in my mind that as a financial services business, we are more impacted, and more frankly, we just have a lot more leverage to what AI can do, because it is an information business. It's information in, credit decision, pricing decision out, providing that customer service, and providing a return to the investors and the credits on the back end. AI can help with a lot of all of what I just described. Having said that, I don't think it's going fully automated. Absolutely no humans. Not for a long time. So on the underwriting side, that's where you see a lot of potential for sure. I think our merchant score, it's a kind of AI 1.0, which was machine learning. Now with the language models, to your point, we could actually have the language model spit something back that we could then incorporate into our score. I think that's the way we would think about using LLMs in that context. LLMs are helping our underwriters get a complete summary on a deal in a way that just saves them a number of clicks and actions, and kind of like research work they used to have to do manually. So that's awesome. So I think in terms of just kind of how much volume can be done per underwriter, that number is climbing and climbing and will continue to climb with AI. But I still, it's still a ways away to the point that you don't use them at all. Now, we already have no underwriter on some files, right? So if it's a really small file and it looks very normal, like there's nothing unusual about that file, then we have a separate model that kind of answers the question, is this the type of file that could be an automated funding? If it passes, that model, then we actually will put it through as an automated fund. Again, very, very cookie cutter, simple scenario for a small amount of credit. If it's a larger amount of credit, or if there's anything unusual, then it kicks out to a manual review. So it's kind of like, AI is like your autopilot. Basically, commercial airline pilots haven't really flown planes in many, many years. They just, pull on the yoke or the stick just to take off, and then they just pull on it one more time when they're landing, and the rest is all automated. But they're there just in case, and they're there for that, like those couple of really important moments. And I think that's how we think about AI in underwriting. Is you're gonna have those edge cases and unusual scenarios, this or that, or just changing environments. So you're always going to want someone kind of overseeing the whole thing too. Now, on the sales front, I think there's less leverage from AI. As exciting as voice AI is, and the fact that, sales is it's just a conversation, so it's just language, and so you think just AI is going to take that over. But I don't see that happening very quickly because, there's a trust building that needs to occur, and you want to get that commitment from the business owner, and that commitment's really only felt in a human conversation as opposed to a machine conversation. So again, though, you can do more volume per salesperson, and some of that kind of more prospecting type work, lead nurturing type work. You could have AI do some of that, but I don't see the death of the salesperson anytime soon as a result of AI.
The death of a salesperson. Well, what about the fraud? Is AI on the fraud desk, the fraud file? Can you see? Because you often hear that
it can be helpful there.
Maybe security as well, cybersecurity.
Yeah. No, I think it can absolutely be helpful there, and that we're already, I mentioned the AI summary for the underwriters. There's things that the AI is being prompted to check for that can help there. I mean, look, it's going to be in everything. It's already in a lot of things. So it's a fascinating dynamic time, especially if you run an information business.
That's true. As you were talking, it just the thought popped in my head to say, hey, maybe I should run a Fintech conference just for AIs. I wonder that would probably be not that interesting.
Just watch the AIs attend the conference and talk to each other?
AIs attend the conference and take it over. I would never will. So we're moving down our list of topics that I want to talk about, and we're getting to the next one. One thing is about Merchant Growth's business and scaling it, and in the research, like $1 billion is a pretty big number, and 15,000 businesses. But are you like, how much volume do you do a year annually? Is that something you'd be willing to share? Or is
Yeah,
that
I'm fine to share that. Yeah, I've posted it on LinkedIn before. And I mean, it's moving around, and we're growing, but we're only halfway through this year, so I can't tell you exactly what we're going to end the year at, but we're in the sort of we're doing over 400 million a year.
400 million a year right now? You're
Hmm.
scaling.
Yeah,
Beautiful. So that's
yeah.
exciting.
Our since inception number is almost 1.5 now.
Yeah. Yeah. Wow. Fantastic. So can't even keep up with it. So during my research, I came across the Merchant Opportunities Fund. Is something that you're leading. Could you talk a little bit about what that is and how it works? And
Yeah, definitely, Craig. Yeah, that's how we fund the portfolio. So,
yeah.
Merchant Opportunities Fund and Merchant Growth are, uh, you know, they work very closely together, the two companies, right? Merchant Growth is the originator and servicer of these Canadian small business financings, but the actual risk sits with the fund. So the fund is the balance sheet, uh, you know, um, the contract that the borrower signs is with the fund, because the fund is the actual holder of that credit. Um, and we set it up that way, for two reasons. One, it's what I knew, because I came out of that private equity world where I learned about fund structures. But two is because I knew that if I was going to have to raise all this capital to do these financings, if I was just going to use a corporate balance sheet to do it all, I'd end up diluting my ownership in the business, considerably in order to accomplish that. And the valuable piece is the brand, the ongoing origination, the underwriting model, the data, the referral network, et cetera, et cetera. So that's where the value is. The person funding the loan just wants a yield. So it's a very different type of investor for a different purpose. And so it's just separating those two made a lot of sense to me. And so we've always funded the financings out of this credit fund, and then the actual operating business is a separate entity. And so investors across Canada and frankly globally can actually invest in Merchant Opportunities Fund. We have over 1,000 investors. Folks are getting, last 3 to 5 years, we've been consistently doing sort of 12 to 14% net returns to investors. So I think that's pretty good. We're pretty proud of that, and investors seem pretty happy with that. We're also distributed through some of the broker dealers. And so wealth managers are also buying it for their clients too, in some cases.
Are you looking for more BDs like broker dealers? So just, there's bound to be some listening to the podcast. So I would throw it out there that if you are, that they should come talk to you, of course, for
Yeah, sure. I mean, yeah, we're approved at three good independent broker dealers. We are looking for more. We do. It's one of those chicken or the egg things. You need to get some advisors that want the product, and then they champion you internally with their product approval folks. And so that's a process, and it took us a long time to get a few of the approvals that we do have. So right now we're more focused on just building relationships with the advisors at the shops where we already have approvals. But obviously we're all ears to anyone who thinks this is an interesting asset class.
One interesting question here I've got on my hit list is the Canada's SME pipeline. There's this idea right now that there's not a lot of, I mean, small businesses, everybody knows, is the backbone of many countries, including Canada. I mean, they're where all the jobs are, where all the GDP is. But there's a lot of talk about things have slowed down. Maybe they're talking about startups. Maybe they're not necessarily all SMEs, consumer facing, that you might be integrating with for loans. But do you? But it was an interesting question that I wanted to get your opinion on. Where do you see Canada's sort of entrepreneurial pipeline these days? And because it feeds directly into your SME, lending business.
Yeah.
And is that a concern? Like, are we drying up here? Or what's the future look like?
From what I've gathered, it could be better. I mean, obviously we have less immigration now than we did a number of years ago, as well. And the economy generally just has been, as a whole, pretty sideways. It hasn't been. We haven't really been in a recession per se, although we did hit a technical one this year for a couple of quarters. But it really is just kind of sideways and sort of status quo. And I'd love to see it be better than it is. One bull case I have around AI is that it's going to be that much easier to be a business owner, right? In the past, the intimidation factor of incorporating and signing a lease and, navigating insurance and certain regulations, et cetera, for whatever it is that you're doing, all of those types of activities are so much easier now with AI. I mean, and so, yeah, the cost to get started is much lower, and the intimidation factor is lower. So hopefully more people end up kind of embracing the potential that brings to be business owners.
Yeah, you still need the proper business plan, the underlying business case, but I guess the automation of those workflows can be streamlined, which through AI.
Yeah, I just think, how many times has someone just kind of randomly said, "Oh, this would be a business idea,"
Yeah.
But it's almost never acted upon because it's just so much work, and it's and people don't have the confidence. It's I don't know how to do that, and maybe AI can just make a few more of those random idea conversations into real things.
The back of the napkin igniter. I like that. Yeah, it's an interesting perspective. So we're going to talk a little bit about the future of alternative finance. So looking ahead, what excites you about alternative lending, for small business financing in Canada? These are trends in industry that you've seen or you'd like to see develop and happen. Maybe they're happening globally, but why not here in Canada? We often say, what are your thoughts there?
Yeah, Merchant Growth has a mission to bring Canadian business owners the most convenient, accessible, and trusted financing experience. Convenience speaks to how easy it is, the speed, the algorithms, the AI, being able to kind of give business owners their time back because business owners wearing multiple hats. They're doing marketing, they're doing operations, they're doing finance. They want to get back to just working with their customers and doing what they're passionate about. So we give them their time back. So I see us continuing to execute on that. Accessibility speaks to that broad spectrum of risk appetite and being able to say yes more often than not. And then trust is kind of just continuing to build out brand and awareness of our entire space. We did a survey of 1,000 businesses and not of our customers, but just random small businesses, and to get a sense of how aware they are of not just Merchant Growth, but non-bank small business finance. And less than 10% of business owners were aware of it at all. So still a lot of work to be done there. As you can imagine, they all know the big bank brands and so forth. But our space still has work to do on that front. I think as we continue to gain scale, we're able to, feasibly lower the rate to customers because of just operational economies of scale, but also our own cost of capital going down as we gain scale. And so that will allow us to, move the business, what I call up market, so into slightly larger businesses, slightly larger loan or credit amounts. And at more competitive rates. And that will really also allow our space to kind of move out of the kind of alternative kind of shadows. I don't know, that's probably the wrong term. That sounds weird. But, the word alternative itself kind of makes us sound like, these sort of this higher cost, higher risk credit offering, and I don't think we have to be. I think that we can move more into the mainstream with scale, and so that's something that we're working on, and it's not easy to do, and you need to get scale, and you need to do it incrementally and thoughtfully. There's been other small business finance platforms that have really tried to lead with a low cost product to try and get the kind of lower mid market business, but when you don't have that scale, it's really hard to actually execute on that plan and do it sustainably. So yeah, I mean, I see that it's just it's just going to get easier and easier for businesses to get credit. And that's what we're here to do. And I think that's a very exciting future.
So if merchant growth's at, cumulatively that $1 billion figure is more like 1.5 billion, where does that scale look like for you? And I mean, it seems to be ramping up, and to your point, like there's going to be more access to credit and more awareness. We're only at 10% of education. And sometimes we're getting a bad rap calling it alt-fi or alt-lending or alternatives, as you're saying. We're the band members. Yeah, we're the alternative indie rock guitarists and singers. But really, we're just trying to help. And it's non-traditional, non-bank loan lending. But do you ever envision a point in the future where alternative lending or alternative finance is going to get so big that it will invert with traditional bank lending, or that's
it's not impossible. It's not impossible. And I mean, at the end of the day, the banks still play a meaningful role. I mean, like at Merchant Opportunities Fund, we get back leverage from BMO and a few other Canadian banks. So, part of the capital that goes out with every single merchant growth financing is coming from banks. So, they still play a role there. I do think we can build better customer experiences. I do think that playing field is leveling out. Traditionally the smaller kind of more startup-y business who's building from scratch, not burdened by legacy systems, is like in a better position to build, elegant user experiences and stuff. I think that is actually leveling out, where that advantage that the smaller startup has is going to become less, just because everyone can code things with AI and stuff. But in any event, though, there's even if banks start building better experiences and faster experiences for small business credit, I'm also just not overly worried about that from my standpoint, just because there's such a big spectrum of risk, and the banks are always only going to address a sliver of that spectrum, kind of by design, also due to regulation. So, I think that the numbers can certainly continue growing here, but it's not easy, and it's always changing. We've been traditionally kind of like a high growth business over our 17-year history, but we went through a huge disruption during COVID, where our new volumes went basically almost down to zero for a little bit and slowly built back up. So you never know. There's always things that can change, and the economic cycle also, does what it's going to do. So it's a fun business in that, you're having to think about a lot of different things at once, as you're, trying to execute on growth in, a space like our own.
Well, you're sitting in a pretty good spot, I'd say, David. Quite impressed with the success you've had, and quite frankly, your perspective, your attitude on, and you're still very, very vibrantly trying to help these small businesses and build and scale that business to what your successful will look like. So as we move towards the end of the podcast, I want to touch a little bit about the innovation and success for merchant growth. So do you have any products or ideas that are coming in the pipeline that you're just super excited that you can mention it? Don't give away the secret sauce, but what's coming out that you feel you can feel it vibing here over the next 3 to 5 years, that's probably going to be an integral part of that scale, that growth?
Well, we're like as busy as ever in our tech team, despite AI being able to help you code. We've actually added developers even in that scenario, and we're shipping more and more stuff, which is awesome. I would say there's no single thing that I could say to you right now that you'd be like, wow, that's totally insane. It's more like it's a lot of little things, getting a lot of little things right to make that, to execute on that mission of bringing the most convenient, accessible, and trusted financing experience to those businesses. So, the ability to refinance and access more credit as you've paid down your initial financing with us. That historically required a few manual steps. We're making that entirely self now. We are, we're actually, frankly, we're rebuilding our loan management system, which is a huge project. That's entirely back end, right? Customers not even going to notice that, but it's going to allow us to, use AI in a more powerful way and scale our business and innovate on products faster than we historically would be able to once we have that new infrastructure. Yeah, we're launching a mobile app very soon. That's going to bring a lot of those self-serve features, right into your mobile phone and allow us to communicate with you through push notifications and all that good stuff. So, there's tons of stuff we're working on. No single thing is like totally earth-shattering. At the end of the day, our product is to get credit flowing into Canadian small businesses. I will mention one other thing, which is Merchants Market. We have a marketplace of vendors and partners that can be accessed on preferential terms if you're a merchant growth customer. Anything from kind of payments, payroll, legal, insurance, et cetera, et cetera. You can see with the different options that are out there and the pros and cons and like really kind of elegant product sheets and sign up right then and there with preferential pricing. So that's kind of we're trying to empower small businesses. Financing your growth is just the start, and we're trying to give you the tools that you need to succeed in whatever vertical you operate in.
And do you, which is an excellent idea. You've touched upon a few great ideas. I'm wondering about going global. Do you ever think this is something that merchant global growth?
It's a debate we've had. We've been around long enough to have that debate a few times, right? Having been in business 17 years, we've always come back to let's just stay focused on Canada. There's still so much work to do here, and we just don't want to drift our focus into multiple jurisdictions. Financial services don't export across borders super easily. We're now going to have to train a model on new data. We're going to have to, set up new infrastructure in many respects as it relates to, banking, legal, et cetera, and regs that you got to comply with, et cetera. So it's a lot of work. But I think that it's certainly not off the table. It's something we could get to over time. We do have some thoughts as to how we might do that if we were to do that. But I would say that in the near term, we remain just really focused on Canada.
And last question before we get into the rapid fires here. 5 years from now, what do you think success for merchant growth and for Canada's small business community, what do you think it's going to look like for you from where you sit?
I think rather than, more than any single KPI, it would be, I'd say we would have succeeded if we're more of a household name where it's like, hey, merchant growth is that platform that, supports you in financing and other ways. If you're a small business owner, just becoming a household name. If we do that in the next 5 years, I'd say that's success. And across the whole space, if you just have, we survey the business all the time, and it's like, what are your main pain points, et cetera? Like maybe access to capital could drift down on that list a little bit if we can solve that a little more. I don't think it'll ever be completely solved. And of course, this might sound harsh, but not every business should be funded, right? There is that adjudication overlay that you always need to have, and that's the mechanism where capital actually flows to the right ideas that should be funded. But that's all to say that there's always going to be some businesses complaining that they wish they had more access to capital. But nonetheless, right now that complaint is way too frequent and too often with pretty much every small business. Let's make that less of a concern.
Yeah, here. And it's really sometimes a dagger to heart when that same question, that same company or a number of companies feel the pain so badly that they have to leave Canada, and that really hurts. And none of us want that. So I hear you, and
good point.
luck with well, we see it, and we've seen it we don't like it. And, if we can have a hand in helping it, I think we owe it to ourselves and, all the small businesses to do what we can for them. But, okay, well, let's get into these rapid fire questions. They're just going to be quick. I'm expecting sort of quick answers here. So if you're ready, this is just something we do in the podcast. You just add a little flavor, little color. So are you ready for these quick questions?
Yeah.
Okay. So first one, biggest myth about small business financing.
It'll take a long time to apply and figure out what you're able to get.
It's as quick as 1 minute from what I've heard.
Just a few minutes. Yeah.
It's just a few minutes. If you connect your bank account and
You got it.
Next question, rapid fire. One financing mistake founders make too often.
I'm now going to talk not just about kind of like Main Street small businesses, but also, the more kind of venture startup ecosystem, which is just picking the right capital solution depending on what it is you're investing in. If it's going to produce cash flow predictably and quickly, go with credit. If it's risky, go with equity. Sometimes people just mix that up, and then you get caught up in weird situations and it's suboptimal.
Good answer. One technology that you're watching pretty closely.
I mean, how can I not say AI, man? I mean,
You're not watching going to the moon with SpaceX or something?
I'm just so focused on my business that I look forward to the live stream when someone's landing on Mars, but I'm not spending my days, tracking that progress.
Yeah. Yeah. Well, I am waiting for the nanobot to get clean my cholesterol out of my veins. I'm waiting for that one. Just clean me. Like, I don't need a pill. Apparently these nanobots, they've been talking about it for years. Just go in and clean me out. Next question. One lesson that you would give your 22-year-old self.
I get a shareholder agreement. I didn't have one at first, and I paid for it.
There you go. It's like getting a will. You need a shareholders agreement.
Yeah. Even if it seems like you're getting ahead of yourself, and it's like, this isn't even a business yet. Like, it's like, you know what? It's not that much money. Get that shareholder agreement in case it becomes something.
Well, it can always come something. So I think it's probably the biggest, most salient piece of advice that an entrepreneur that might not know, that absolutely get a shareholders agreement. I mean,
Yeah.
Last question. What still excites you the most after 17 years of being a digital lender?
Seeing people on my leadership team grow into bigger and bigger roles, looking after more and more things, and they themselves leading larger and larger teams. It's been awesome to see people grow in the company.
Excellent. That's I can envision leadership team M&A buyout coming in 10, 15 years. But you only started 22. You got a lot of years left. You got to keep some years on the back end of the runway to get back into the band. Get back into the band. when you're touring again, we'll come out and we'll see. Let me know when you're touring.
I'll let you know next time I'm playing in. You're in Toronto, right, Craig?
Yes, well, actually, I moved to Waterloo a number of years ago, so I'm in Ontario. All right.
I don't have any gigs coming up over there, but I'll let you know if
that's awesome. Go down to the Horseshoe Tavern or something, or maybe you're playing bigger venues. I mean, with Alice in Chains, you're playing bigger venues than the Horseshoe.
At that time, but yeah, not anymore.
Okay, well, this is wrapping up, I guess, for the benefit of listeners, and I had a lot of fun on this chat. We like the vibes. Want you to get your information out though. Like, how do people contact you if they want to learn more information? Maybe the website, the email, all that good stuff? How do they?
Yeah, if you're a small business owner looking for credit, looking for capital to grow your business, then find us at merchantgrowth.com. And if you're an investor looking for income producing investments and you want to support small businesses in the process, then Merchant Opportunities Fund is something that you should look at. That's merchantopportunities.fund.com.
Thanks so much, David, for joining us, sitting down here, valuable time. I've learned a lot as usual, and as I mentioned, it was a great conversation. So kudos to you, and wishing you and all the leadership team and Merchant Growth the success that you're looking for, and all the help that you're providing to small businesses. So. It's absolutely fantastic.
Yeah, I had a lot of fun, Craig. Thanks a lot for the time and for having me on. Appreciate it.
Absolutely. So if you're just, to close things out here, if you're new to FinTech Fridays, please check out some of the incredible past episodes on the site. I think you'll be surprised with what you find. We look forward to seeing you next Friday for another episode of FinTech Fridays. Have a good weekend, everyone.
You've been listening to FinTech Fridays, brought to you by NCFA and Partners. Tune in weekly for the latest FinTech Friday podcast by subscribing to this channel. The National Crowdfunding and Fintech Association of Canada is a nonprofit actively engaged with social and investment fintech sectors around the globe and provides education, research, industry stewardship, services, and networking opportunities to thousands of members and subscribers. For more information, please visit ncfacanada.org.